Imagine you invest all of your money into one particular company, and overnight, that company drops 40%. So think about this. If you invested $10,000 into that one company and it drops 40% overnight, that's $4,000 gone, right? Would your financial plan survive? Today, my husband and I, we're going to talk to you about the mistakes that we made along our journey when it comes to investing. But not only that, we also want to talk to you all about the opportunity and diversification that we want to hone in on when it comes to investing. So walk along our journey and stay with us in this video as we talk to you about the things that has helped us, truly has helped us and build confidence in investing as a couple.
Please like this video and subscribe to our channel. There's a verse in the Bible that really hits home when talking about this topic of diversification. And it's in Ecclesiastes chapter 11, verses 1 through 2. And it reads, "Ship your grain across the sea. After many days, you may receive a return. Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land." And so this verse really lets us know that one of the things to investing and being successful is having patience. You know, it said across many days. And so having a long-term perspective to investing, that's very important. Right. You can't just expect, to invest 1 month and get 100% return, consistently. But patience is a foundational part of your investing. Right. And number 2 is you have to manage your risk. You have to be able to diversify your investments, not just concentrate all your funds in one investment. It says 7, even 8. And so that's very important to being able to manage your risk. And also, it talks about multiple streams of income as well. That's for another video.
I know.
But we're going to get into our conversation about diversification. Exactly, what is diversification and why should couples care?
Yeah. So diversification, it is very important for everyone, because there's a saying that states that don't put all your eggs in one basket. And that's literally what diversification is. And so when you think about diversification, it really helps reduce risk. It really does, because it allows you to diversify in different stocks and different ETFs. So if one stock goes down, then you have the other stocks or other ETFs that will help with your portfolio, right? So if that stock is performing poorly, then you have your other stocks, your other ETFs, right, that are performing well. So I want to use this example. If you're going on a road trip, right? So we have some people out there that love road trips. You are packing your cooler, you have your snacks for your kids. We went to Walmart, we went to Target, or even Dollar Tree, right? And we got all the snacks for our kids. And then we also have what else I want to say? We also have not just our snacks, but we got our pillow, we got our cover, we got everything, right? But in order for us to go on this road trip, we need 4 tires. Right? To keep going. But if one tire goes bad, then you have your other tires that keep going with that donut hole, right? But those other tires keep going. That's how diversification is that if you have 4 stocks and one stock goes wrong, then that stock does not derail your whole portfolio. Those other stocks or those other ETFs keep going, right? That's what it is. Now, diversification is not going to, it doesn't guarantee loss or guarantee profits, but what it truly does, it guarantees that you are ensuring that your portfolio doesn't derail because all of the hard work you put in over the years. That's really what diversification is, baby.
Oh, I love it. I think that's a great analogy. And I enjoy road trips. Yes. To be honest with you. But as we talk about diversification,
Yes.
it's very important.
Yes, I love it. So, baby, what happens if you don't diversify your investments?
If you don't diversify your investments, your portfolio is going to be singing the blues. I know there's people that like the blues out there. And I know that you have a saying the blues is all right, but when it comes to your portfolio, you don't want your portfolio singing the blues. It's not all right. You want your portfolio to be singing something upbeat.
Right.
Like Tony, Tony, Tony. It feels good.
Feels good.
And so that's very important. And so in order to do that, you can't concentrate all your risk into one company or even one industry.
Right.
Because if there's a market turn, if there's some news, if something goes down drastic, if the whole industry goes down, you're going to be hurting, and your portfolio is going to be singing the blues. And so it's very important that you spread your risk amongst multiple industries. And so if the technology industry is down, you might have healthcare, you might have energy, you might have some other industry to help offset that, the downward pressure on your portfolio.
Yeah, you bring up a great point, because my husband and I, we didn't get it right. We started investing in ETFs, right? And I think that piece we did get right. But when we started investing into stocks, we didn't get it right. Like, we had different stocks. We had Meta, we had Tesla, we had Nvidia. Like, we had different stocks, but it wasn't diversified the way that it should have been diversified, because we really didn't understand. Like you hear the saying that says, don't put your eggs in one basket, but when you think about the stock market, that's what it is too, right? So being able to diversify. So we did make those mistakes, and that's why we're here. We really want to show couples the right way in diversification too.
Yeah. And I think, we were too heavily invested in one industry. And so I think that was a big lesson that we had on, even though the industry was popping at the time, but it's great when it's going good, but then when it hits a roadblock or it hits a tire blows out, you have to change course.
Right.
And so that's something that we had to learn the hard way. And so number two, how many investments should you own?
So that question is always being asked, and it was one question that we asked ourselves. But it's for anybody. It's not about how many investments should you own. It's about the consistency of investing and diversifying your portfolio, because you can own thousands of companies and thousands of ETFs. That don't mean you get it right? But what it does is it allows you to understand what's your financial plan for your family and how you're able to diversify your portfolio so you can protect the hard work, the money that you've worked so hard, right? But the other piece too is that it goes back to okay, are we going to invest into 5 different companies in the same industry, right? No, because we got it wrong, right? Are you going to invest into the Nvidia, the Tesla, the Apple, the Google, the Microsoft, right? Or do you want to invest into financial services, energy, industrial, what else? Consumer goods, technology, even healthcare, right? We're not saying invest into all of them, but what we're stating is that consistency and patience and diversifying your portfolio, understanding your risk tolerance and how you're able to move forward, right? And so for us, I think ETFs, we started with 3 different ETFs, and then we added in like a dividend ETF as well that really helped bring in income as well. I use this as an example. You go to an ice cream shop, right? You go to Brahms or you go to Baskin Robbins. We got some Baskin Robbins out there, and you get 5 ice creams, all vanilla, and you realize, oh, I don't like vanilla. Well, that's not going to be good, right? Because then all the other 4 you don't like. But if you go out and you get a chocolate chip, you get mint, you get strawberry, you get chocolate, you get all the different flavors. That's how diversification is. That's truly how you should be able to move forward when it comes to like your investments and how many you need. So being able to just start with one and then add two and then add three and so forth and so on.
I like that. That especially when you talk about ice cream.
Yes.
You know, that's a wonderful analogy. And I like mint chocolate, and I like cookie and creams. I like all those different type of flavors.
Yes.
So that hit home.
Yes, I said vanilla because you know I don't like vanilla. But how often should couples review their investment portfolio, baby? That's a good question.
That's a great question.
Yes.
You don't need to review your portfolio every day
No.
or every week, you know, even every month. You know, it could be 2 months, it could be 3 months, you know. And so what you want to do is be able to come together every maybe 3 months or 4 months and just ask each other questions. You know, are we still investing consistently?
Right.
Are our financial goals still the same? Are we still have the same financial goals for this portfolio?
Right.
Are there any investments in the portfolio that have grown so much that it's overweighting the portfolio? And so basically what that means is it's gone up so much that you're taking on more risk if that particular company or ETF or whatever goes down.
Right.
And so you just want maybe you need to rebalance it and, you know, shift some of your risk and diversify it even a little bit more.
Right.
And another thing you have to think about is, you know, if you have a major life event, you know, sometimes, you know, life events happen, they pop off unexpectedly, not on schedule.
Right.
And you might have to pause your investment or investing to get through a temporary storm that you may be facing. So those are a few questions couples can ask each other, and you can make it fun. You could, you know, celebrate your progress.
Right.
You could get together over some coffee, review it together, you know, ask some questions and see if you have too much spice in your portfolio or too little spice. Watch one of our previous videos to understand that.
You bring up a great point. There was two. One, you really talked about life events happening and being able to pause your investments. And I think that's another piece that we really want to talk to couples about, because it's okay to pause it, right? Because life is going to keep happening, but it's okay to pause it, knowing that, okay, I'm going to pause it, but eventually we're going to get back into that thing.
Exactly.
Right? And being able to understand and talk to each other too. The second piece, baby, is that one of the things Frank and I do is that we look at the S&P 500 and we look to see how did they perform throughout the year. Like, how are they performing throughout the year? Because we know S&P 500, they perform what, 8 to 10% on return. That's how we look at our portfolio. How are we performing, right? Not necessarily are we beating the S&P, but how are we performing? Are we at 10 to 12? Are we at 15%? Are we at 20%? And so that's another piece that we really want to talk to couples about when it comes to diversification and investing as a whole. The advice we would tell couples is don't chase the numbers. Don't chase the numbers, but really build a balance when it comes to diversification and do it together and really talk through it as well. Because if one person doesn't feel at ease, but the other person feel at ease, let's talk this thing out. Let's really understand why my husband doesn't feel at ease or why I don't feel at ease, and how we're able to move forward as a whole. So we pray our video truly blesses you and your financial journey. Drop it in the comments if you heard. Don't put your eggs in one basket.
Please like this video, subscribe to our channel so you can see what's coming next. Your financial journey is better together.